Can you imagine how many calls anyone who works at SpaceX gets every day for a job offer? Can you imagine their LinkedIn profiles and the messages in the LinkedIn? It's ridiculous, right? You almost need a talent agent to manage their careers because there must be so many people who want to access that talent.
In the prior cycle, the model training era, if you will, companies were able to fund it all from cash flow. They would just spend their entire operating cash flow on CapEx and this build out. Now we are entering a phase where cash flow is no longer going to do it. We think it's going to be about 3 times as big. So if they're generating 100 to 200 billion in cash flow, now they're going to need something like 3 to 600 billion. Right now, most of the AI usage is subsidized. Then I don't know that people think about it that way. So when you're using ChatGPT, you're losing money for ChatGPT, or when you're using Anthropic loses money on that use.
Most people think about AI through the lens of ChatGPT, Claude, OpenAI, Anthropic, or NVIDIA. But those companies represent only a small portion of a much larger ecosystem. I think the purpose of this conversation is to understand who actually makes money in the AI economy. So if OpenAI spends $1 today, where does that $1 actually go? Today, Ivana Delevska, founder and CIO of Spear Investments, joins Paulo Passoni and me for a special TGC debrief. Before launching Spear, Ivana spent years investing at firms including Citadel, Millennium, and Tiger-affiliated investment platforms. Today, she is one of the sharpest investors covering AI infrastructure, semiconductors, networking, power systems, and the broader AI value chain. AI infrastructure may be one of the most important investment themes of the next decade. So we started with a simple question. If OpenAI spends $1 today, where does that dollar actually go? We break down who actually makes money in AI, where the biggest bottlenecks are emerging, and what parts of the value chain investors might be dramatically underestimating. We discuss SpaceX and Anthropic as they prepare to enter public markets at valuations approaching $2 trillion and $1 trillion. What assumptions about the future need to be true for those valuations to make sense? If you care about AI infrastructure, technology, and investing, this conversation is for you. Follow us on our channels on Spotify, YouTube, and Apple at The J-Curve Podcast, and subscribe to our newsletter at www.thejcurve.com, or follow me on Instagram at Olga Maslikhova with KH. Let's get into it. Most people think about AI through the lens of ChatGPT, Claude, OpenAI, Anthropic, or NVIDIA. But those companies represent only a small portion of a much larger ecosystem. Semiconductors, network and data centers, whatever, you know these things much better than I do. So ultimately, I think the purpose of today's conversation is to understand who actually makes money in the AI economy. And I think we're going to start with this simple exercise. So if OpenAI spends $1 today, where does that $1 actually go?
What we've seen over the past several years is that the hardware layer is the one capturing a lot of the value. Not just from a revenue perspective, but more so from profits, right? So what we're seeing is that the chip space you mentioned, networking, memory, all of those are seeing unprecedented growth as well as really strong margins. So to answer your question, the split is basically about 50% goes to compute and 50% goes to the rest of the hardware layer. About 15 to 20 is networking, about 15 is power and related components, and the rest is basically the physical build-out, the actual infrastructure behind building the data center.
So for those people who hear about physical build-out and infrastructure but have no clue what it actually represents, if you were to break down the supply chain, in as many details as you can, and the map important parts of that supply chain, how would you do that?
Well, everything is important, right? The first step is to secure the chips, and I think that was the bottleneck 3 years ago. Now that supply chain has ramped up and there is ample supply of chips, whether it's from NVIDIA or some of the new competitors that have entered the market, then you have the networking layer. This is where there is a lot of changes because basically the compute has by now been optimized, but how you connect these chips is really where you're getting the incremental performance improvements. So that's really a very important part that we spend a lot of time focusing on, figuring out what are the new components, what are the new ways of connecting these systems. And then the physical build-out is literally finding a site and securing the power for it. And it's not necessarily, people think that we are power generation constraint. That's not necessarily the constraint. It's more about finding the right power generation at the right place that's close to a fiber optic network that where this data can actually flow to places where it's useful. So it's really more about finding these sites, which is not easy, rather than actual power supply.
When you think about finding the sites, what are the areas, geographies, locations that you think are lucrative and interesting from that perspective?
So what we've been seeing a lot in the US specifically is that there is a lot of regulation that governs the independent power producers and utilities. So a lot of the new sites and developments have been centered around behind the meter power, right? Where you're not connected to the grid. So there is some value to that, right? Another one that's very interesting is some of these companies that build as Bitcoin miners, they build out the entire infrastructure around that for something very similar to operating a AI data center. So those are ones that are really standing out right now because they have not only secured significant amounts of power and sites, but also have a pipeline of further sites that they can develop. So there are opportunities. I mean, another one is space, right? So we're going to be hearing a lot more about that. But I think that is a legitimate alternative, not necessarily in the near term, but we will see a lot of progress being made in the next 3 to 5 years.
By the way, it's amazing to have you with us in our first episode of a guest. We've been friends forever, and it's a pleasure to have you here. Two things that come to my mind. I was talking to an entrepreneur from Latin America. It's actually an American guy in Latin America, and he's trying to crack the code of supplying that kind of capacity to the hyperscalers with the advantage in LATAM of cheaper electricity, faster permits depending on the country. Also, water for cooling is going to become an issue, and a lot of places in LATAM have plenty of that. So I think the data center cost part of the equation can be a third of the cost in LATAM versus the US. And the question is, how much faster can it be? Because it has to offset the higher cost of capital. No doubt that if you build a data center in the US, you're going to have the lowest cost of debt. If you build it in a country in LATAM, you're going to have a little bit of a higher cost of debt. But perhaps there will be solutions provided even by the US government to facilitate that construction as long as the capacity keeps geared towards the US players and not the Chinese players. So I think there's a lot of that LATAM can try to make money and take advantage of this opportunity. We're in these super early days because this whole thing is so new that all the entrepreneurs are just now kind of trying to figure out how to do these things. And the countries where you could do this could be Panama, could be Colombia, could be Chile, could be Argentina, could be Paraguay, could be Brazil. There's a lot of places where this whole thing fits. Lastly, the question of fiber connectivity is one of the key ones. Of course, there are two use cases. One is to train the model where that doesn't matter as much. The other is inference where that matters a lot. So it also depends on that. One last point I was going to tell you is I saw Arvin from Perplexity talk about running inference in a hybrid way. So part of the inference gets done at the cloud, part gets done in your own hardware, be a Mac Mini, and now he's going to launch on PC. All to optimize the cost benefit of the process. Because ultimately, right now we are in a situation, I feel like for users, this is so new, I need to understand it. I fear being outdated, so I'm going to spend whatever money it takes. But very soon, people are going to ask, how can I optimize this cost? Because it's getting out of control. You already saw that with the Uber CEO interview a couple of days ago. You're going to see that more and more often, even large enterprise customers saying, okay, hold on.
Well, you mean Uber CEO, you mean like capping monthly expenses to like 1.5 grand per person?
Data spoke about exactly that. So they spent in one quarter their budget for the year.
The thing that you said about Latin America is super interesting because, as you know, we did have this panel with I2, and they were talking a lot about physical AI build out and how bullish they are on actually Brazil specifically. And at some point they were saying that, you know, like when you look at certain countries in Europe and then Brazil, in Brazil, you're taking less risk because, some European countries where you can potentially roll out those data centers, they're too close to Russia and all of the zones of conflicts, and Brazil is so far. So even though there's a lot of
And the Europeans are the kings of creating regulation for the sake of regulation, right?
Exactly.
I mean, the French exported the mindset to some countries in Latin America as well, including Brazil. But now, let's see, I think out of pure sheer competition and fear of being left behind, perhaps countries will find a way to expedite that. I'm not super optimistic, by the way, because very few countries can get their act together. Internally, there is a lot of different interests and people influencing in different ways. Even in the US, there's a lot of nonprofits now trying to slow down the data centers. Who knows who's paying for the nonprofits' campaigns, because there's a lot of speculation that could be even out of China. I have no idea. But there is that aspect of the physical build out facing the reality of the speed of construction of real things, which in the West we do it differently than in China, right? Like China is the best place in the world to build anything. They are the fastest. They have also mastered, because they've done so much of it, they're actually better at it, in addition to being faster at permits. So the West now has a little bit of a challenge to deal with this. Perhaps that's where the space thing comes up, because in space, none of that will matter.
That's a very interesting thought, both in terms of China, but also in terms of would it, even for the U.S. support and investors, does it make sense to back this type of big physical build-outs in the U.S., given how hard it is to build anything, actually, in terms of public infrastructure and private infrastructure, versus funding the projects that in, for example, Latin America, that would have benefits and that would lean towards the needs of the U.S. companies? How do you think about that?
I think you're spot on. The companies that I talk to are saying that Europe, compared to the US, is going to be 5 times harder to build. Mm-hmm. And to Paulo's point on cost of capital, I think what we're seeing a lot is now the hyperscalers are backing these projects. So, for example, Applied Digital is one company that used to be a Bitcoin miner and is transitioning to becoming a big data center operator. So they are making deals with the likes of Microsoft and Google, and basically they will be the one that take the offtake with the power company, and they guarantee the power usage to the utility, right? So, and the utilities used to want guarantees from the likes of Applied Digital, but now they actually prefer the guarantee to come from the hyperscaler itself. And I think that could be something that solves a little bit the cost of capital issue, because if it is the hyperscaler backing the project, but cost of capital is really the key in this, right? It's everything. So
there's a podcast recently by Mark Rohan, the CEO of Apollo, which perhaps is the best at architecting the right cost of capital for big projects. And he recorded an episode with A16Z talking exactly about this thing. The traditional players that have come to the table with the right financial engineering can massively lower the cost of capital and share the risk in different slices in a way that will make it cheaper. For example, the one thing that you have a problem in LATAM is the electricity cost can be in local currency. If it's local currency, then all of a sudden you might have revenues in dollars coming from the hyperscalers, but if you have a local currency cost, the exchange rate will matter. So perhaps you can vertically integrate into the electricity production with a LNG plant and a gas terminal that is all priced in dollars, and the asset just happens to exist in a Latin American country, but both the costs and the revenues are in dollars, therefore the financing is in dollars, and the financing provider is not running a lot of currency risk. So this is one example, okay? And then if you have different types of power sources, you might have more risk, and having to deal with those risks ends up increasing the cost of capital. The U.S., what's a beautiful thing about the U.S. is probably the cheapest place in the world in terms of cost of capital for this type of build out.
If the infrastructure already exists and can be reutilized, right? And what you're saying, I'm curious, what is the scale of those projects, of those partnerships between the likes of Applied Digital and the hyperscalers? What are the amounts are we talking about, and timeframes, and how do we think about those projects overall?
Yeah, so most of them have secured about 1 gigawatt of power. and they have a line of sight to 3 to 5. And really the key when analyzing these companies is not necessarily how much they've secured to date. I think that's step one. It's really more about how much do they have in the pipeline, what kind of relationships they have. To your point, location is very important. So if you're in the Dakotas, it's very easy to bring a plant online and you don't have as much pushback from the local governments.
How do you think about ROIs of those type of projects?
That's a great question. I was talking to this founder. He thinks he can get his CapEx payback in the data center itself in LATAM in 2 years. In the US, it's usually geared towards around 3 to 4 years. Why is it so short? Because nobody knows what the value of those assets will be beyond this current hypercycle. It's cyclical, and the improvements in terms of efficiency of price per token, usage, local computers versus the cloud, all those things we're talking about will represent in a much different usage level. And for that, nobody really knows what's terminal value of the assets. So that means that the returns have to happen with very short-term cash flows.
Yeah, that's right. And what we've been actually seeing is that at the beginning, people were assuming really only a 2 year. So if you're building the H100 or H200, they were assuming a 2 to 3 year usage of those, and then kind of like that they would go out of service. And what we're seeing actually, that prices of those are increasing, and the lifetime is probably going to be double or triple what people thought. So even the first models of GPUs are getting pretty solid usage right now.
So if you were starting from scratch today, the question is to both of you, and could only invest in one layer of the AI value chain, but NVIDIA, Microsoft, Amazon, Meta, and Alphabet were off limits, where would you allocate capital and why?
So we invest across the value chain, and my favorite area is networking. That's where there's a lot of change happening, and optics is becoming a really big component where it used to be used only in scale out in terms of connecting different data centers and connecting the data centers to the outside world. Now we're going to see a time where it actually finds its place inside the servers, so for scale up applications. So I think that's one area that I would highlight as not necessarily under the radar, because those stocks have started moving as well, but it's a little bit earlier in the cycle than things like memory that are supply constrained right now.
Why is that a specific area attracts your attention? What do you think are interesting long-term drivers for that? And what do you think is the size of opportunity given the other parts of the AI stack?
So what we do a lot of is analyze the supply demand. As Paulo mentioned, these segments are very cyclical. So it's all about how much supply you have at any given time and how much demand there is for it. So right now, the demand side, it's not necessarily the problem. So we know it's going to be there. There are a lot of data points pointing to a big step change in demand. So, and that applies to everybody. Everybody is going to see the same benefit from the demand side.
How big?
So what we've been hearing right now with this agentic AI wave, the demand is coming out about 3 times the prior model training wave. So if you look at the order books from the Dells of the world, the HPs of the world, the model training era was a big step change. And now we have a 3 times change from that. And this is why you're seeing Google come to market with a offering, right? Exactly. Basically, like in the prior cycle, the model training era, if you will, companies were able to fund it all from cash flow. So basically, they would just spend their entire operating cash flow on CapEx and this build out. Now we are entering a phase where cash flow is no longer going to do it. And it kind of ties into the numbers, right? Basically, we think it's going to be about 3 times as big. So if they're generating 100 to 200 billion in cash flow, now they're going to need something like 300 to 600 billion. So hence the $100 billion raise for this next cycle.
One thing, was reading this very good note on the sell side. Cyclical industries, there are 2 types of bubbles. There is a earnings multiple or revenue multiple bubble, where that multiple goes out of whack. And then there is a different type of bubble driven by the earnings being super high, much higher than average, and much higher than return on invested capital would say they would get. Industrial companies like mining companies often go through not through the multiple bubble, but rather through the earnings bubble. For example, when I used to be in the public markets, what's the best time to buy iron ore miner? Is when the multiple is the highest, not when the multiple is the lowest. Because when the multiple is the highest, it's probably the bottom of the cycle. And from there on, you're going to get a great return. When the multiple is the lowest, it's probably the end of the cycle. And that's why you should run away from that. Same idea with semis. Semis have historically been very, very cyclical. It's just that we're in a super cycle for semis that will likely extend at least until, call it 2030. I don't know. I have no crystal ball, but that's kind of the feeling I get. So, but at some point, people say, oh, it's very reasonable because the multiple is reasonable. Yes, the multiple is reasonable, but it's the number of years you're going to get that excess cash flow is limited. So even if you do that math and you get a return, great. But right now, the multiples on the cyclical things should be low, not high.
That's why they are low, right?
Exactly.
So basically, memory is one that is like particularly cyclical. Yeah. So if you look at the value chain, basically different parts have different cyclicality characteristics, and it's really mostly driven by how they derive their revenues, whether it's through price or through volume. So some industries like memory, the price really fluctuates significantly. So right now, prices are up like 7x what they were last year, versus you have other parts of the value chain that's not necessarily price-driven. They will price mostly for value they add. So if you look at the semi-cap equipment names, for example, they can charge whatever they want right now, but they're not, because they are trying to prevent that cyclicality. So I think depending on where we are in the cycle, it makes sense to, if you're very early in the cycle, you want to go for the very cyclicals and capture that cyclical growth. And I think we're now at a point where you want to be looking for alternatives in some areas where you may not have the downside if the markets were to turn. And semi-cap equipment is an example of that.
You asked a question, where should you invest now? We are very focused on the application layer, because all the other layers kind of have already happened. What has not happened in terms of massive profits or companies at billions and tens of billions of dollars of revenue is the application layer, because it's the newest one.
And the riskiest one right now, given all of this moves from the LLMs, right, to a certain extent.
But this is why it's so interesting, because the shallow view is Anthropic and OpenAI are going to do every single application layer better than anyone else that can come down the stream. And that's not at all what we're seeing. We're seeing companies that are focused on legal, or companies that are focused on video, or companies that are focused on some specific task, taking advantage of multiple models, orchestrating those models, adding data loops on top with the client's data. That's the stuff that is right now creating solutions that are easy to use and doing early signs that they're doing really well. An example of that would be Higgsfield. Higgsfield was launched more or less a year ago. Company went from 0 to almost 500 million of revenue in 1 year.
Explain what it is.
So Higgsfield is connected to 30 different video models in the world. And then they combine those models to create the best video for you. Most videos are created for the purpose of advertising, either on TikTok, Instagram, YouTube, etc. In the beginning, the go-to-market was mostly focused on consumers, because those are the early adopters. Those consumers helped get the platform to produce 6 million videos a day. Those 6 million videos a day are tagged for performance in real life, which then feeds the algo to further optimize the video creation. Now, where they're going to really monetize is enterprise, not consumer, because the retention levels of consumer is very low, but the retention levels of enterprise is very high. So right now they're growing the fastest on enterprise, and that market it can be 50 billion of revenue. The biggest company being targeted by this type of players is Adobe. Adobe is the one to disrupt on this wave. And players like Higgsfield are moving way faster than Adobe. They have a very, very good talent, and they're just being very smart about how they're building their product without spending all the billions of dollars to train the models. The two best models in the world for video are obvious, is whoever has the best video data. In the West, it's Google with YouTube. on the east side is ByteDance with TikTok. It's as simple as that. That's why those two models tend to be the best models. Of course, other people have interesting models, but those players that at first try to build their own models for videos, they just got out of the race. Everyone is folding their hands in that way of going about it. They're basically saying, let's connect to everyone, let's optimize, because also video creation is extremely expensive, takes a lot of tokens, the budgets can get out of control. I find that kind of layer very interesting, because if you're an advertising agency and it used to cost you $1 million to create a really cool commercial, now it costs you $10,000. What you still need is a very creative person that can imagine what the commercial should be and can put that into practice. Those creative people are going to do extremely well with these tools, but the ultimate cost to produce the commercial is going to collapse. So I think I can go on in many other industries, but the same logic will apply.
What is your take on the application layer?
So from a public company perspective, it's a lot more competitive and it's a lot harder to create differentiated business models. To Paulo's point, there are a lot of ideas, there are a lot of opportunities, but to find a business model that will generate value over time, it's not that easy to do. So we are seeing a lot of opportunities in cybersecurity, for example, where that's an application that's really critical. It's not easy to do. It's not going to be easy to be replaced by an in-house AI agent, right? You do need a professional company that's building this agent. So they are benefiting from using AI internally. That would be one area where it's not only value add, but you can also create a business that can generate durable value. The challenge has been more on the side of like all of these companies like CRM systems, for example. They have a really strong opportunity to capture and use these AI agents to help their customers attract or target better audiences, but they're not doing it yet. So there is a chance for a disruptor to come in and really disrupt this business model with a new type of CRM system that does it better rather than rebuilding something that already exists. So the question is like, how much do you value the installed base? Because that's valuable, right? They've already penetrated the market. Exactly, the distribution versus the solution itself. Because the solutions that they're offering today, they're not quite in line with what's possible.
I agree. And where will be the moat? I think in the case of Higgsfield, the moat will be because you're not only creating the videos, but you're also measuring the ROI of the videos in real life, tagging them, and you control the data. The data doesn't go back to, Google or ByteDance or Anthropic. It stays with them. And that's where the value should reside, because that data is yours, is proprietary. That's going to be used to further improve the efficiency of the creation of the video. And the efficiency has to do with what kind of scene should you have, or which model should you use for this simple thing that costs you less. It's both cost and quality. You got to optimize for both. And with that loop and you controlling that data, I think there is a case for you to have economic profit on top of the solution. Because you're going to have gross margins that are like maybe 40, 50%, because you still got to pay all the API calls for the models, no doubt about it. But you can still create value on top because you have something that other people don't have. On other application layers would be because you're so embedded in the process flow of the client.
I'll give an example.
For example, Valor. We have CRM systems. We have systems of record. Our CRM system, we kind of used one that we liked but didn't love. And the team created a new CRM system from scratch for our own purpose, connected to our emails and etc. using Claude. It took them a weekend. And it's much better than we had before. It's not perfect, but much better. And risks of creating that was low, because if you make a mistake, you might lose a client, but it's not like death for you.
Yeah.
And then the team got excited and said, we want to rebuild our system of record for controlling and accounting of the funds. We have 30-something entities, and we use iLevel from S&P 500. And I said, no way you guys are doing that. Why? Because if you make a mistake, now you're talking about people's money, and the consequences of that mistake is much higher if we have the wrong price per share for the LPs, or we're marking things the wrong way, or we're not setting the right IR calculation and the MOI calculation to investors. That is our source of truth. That I don't want you guys to even bother with. Go build some other stuff, like that system of record. It might not be the best in the world, but it works. And the cost of making a mistake is too high. I think every business in the world goes through a similar kind of situation. What are the things where you can make mistakes? So you take some risk by creating tools from scratch using all the AI tools, versus what are the systems that you absolutely cannot screw up? Because otherwise the entire company goes down, which includes cybersecurity, by the way. You don't want to really run a risk with cyber. This is why vibe coding for enterprise is stupid, because you cannot give any employee the ability to create a new app on the App Store for a large enterprise and that app be, a source of failure for cybersecurity. It has to be tested for that. So whatever goes through a cyber risk goes through a different type of risk appetite. Whatever doesn't really go through that, then you can play with it. That's how I would probably think about it. And you see more adoption and faster adoption in things with less consequences for mistakes. And you see slower adoption in things that have high consequences for mistakes in any kind of business.
He said Moat. Moat is interesting because I just recently had a conversation with someone, and someone told me that, in Silicon Valley, a lot of people are totally rethinking what the moat is, because the moats used to be, technical. And right now, when you have this like horizontal infrastructure, right, like Anthropic, especially for application layer companies, I feel like the definition of the moat is really changing. So how do you think, like you as an investor, for example, private and public investor, think about what moats are in those type of business?
So distribution, I would say, it's an obvious one. The second are data moats that are very specific to you. Only you have the data, and that data cannot be replicated with outside data. I would say, I share again something I learned from the best founders of this current cycle. The only moat you might have is speed. The speed at which you launch new products, the speed at which you're evolving. When I look at a company, any company, and I'm judging not only what they have in that moment, but how fast they got to this point and how quickly they're shipping product. If they're doing that super fast, I can feel good to project that they will continue to do that super fast in the next 2, 3, 5 years. Therefore, I'm going to do well. If they got into this point in 10 years and it took them a long time, and they're not shipping new innovative products every week, they're only shipping every 6 months, then this is an incumbent. It's not a disruptor. Mm-hmm. So I would say the speed at which you're doing things tells me how good your team is and what kind of tools you're using. It's a proxy for how well you're doing. Another proxy is what's your revenue per employee. If you have, $200,000 revenue per employee, something that would be seen as positive 10 years ago, today it's a joke.
Oh, really? Like what's the target right now?
Amazing would be 10 million, but we're talking about between 1 and 10 million.
Per employee?
Per employee. And the evolution of the revenue per employee, it should be going up per employee. It's not like your revenue is going up, but your team is going up at the same pace. It's not good. But if your revenue per employee last year was 500K, now is 800K, a year from now I can see it's going to be 2 million, I feel really good about that.
Is that how you think about moats as well?
Yeah, 100%. Speed in particular is one of the most important things from a public company standpoint. What's happened over the past 10 years, I think a lot of these cool new companies really matured and they really changed the way they're doing product development, product introductions, hired a lot of people. So the pace that they're moving at is much slower than maybe what it was and what is necessary to be successful in today's market. So I would agree 100%. And some of the better companies are really focused on slashing employee count. And part of the reason is for this agility and making sure that you are growing your revenue per employee much faster than just sitting there at a team where things are not really evolving, or you can't really execute at the speed that is necessary.
Are there any specific examples of public companies or private companies that you think are really great example of this leveraging speed as a moat and growing revenue per
I want to hear
employee?
about what you think about anything that Elon does, because that's the ultimate speed guy.
Yeah, exactly. I was thinking the same thing. I mean, that's really where it goes to, and then whoever follows that model is going to be successful. But yeah, in my universe, there are many companies. That's literally the number one in the application layer. The speed differentiation is the moat. So if you look at companies like Cloudflare, Shopify, they're really like still founder-led, and that also adds quite a bit of to the speed equation, right? Where like that entrepreneurial mindset is coming back to really being the moat here, right? So like the companies that do have the founder as still the leader are able to adapt much faster and transition to this. So I would say definitely Elon is the poster child for speed, but then within the application layer, everybody where the founder is still there is a good place to look for.
I think the other example is how quickly he built the X.AI data centers. It was like incredible. I would call him the king of hardware. He's our Western king of hardware. In software, his advantages are less obvious from my observation point. In hardware, his advantages are incredible. It's either his intensity, his questioning, the whole examples of during the Tesla days, why do we have 3 boats in this door? We only need 1. Oh, because the risk guy said we need 3. Call the risk guy. Why do we need 3?
Build that whole thing down to the first principle, like why do we need that?
And he's been mastering this for decades now.
Yeah.
So now he's at a point that everyone that works with him understands how he works. And if they're doing their job, he leaves them alone. If they're not doing their job, he zooms in. Once again, I was meeting this founder, who I think is very good. I haven't figured out yet, but he said in building data centers, you can hire an EPC contractor. What is an EPC? Some independent consultant that is just going to have the talent to tell you how to build, be safe and all this stuff. The problem with that is now you're at the mercy of the EPC contractor. There is a margin in the EPC contracting, and they're going to do things the way they've always done. So instead of hiring the EPC contractor, why don't you hire the people that work there, the best ones, and tell them, can you do this 3 times faster? Do it. And I'm not going to rely on EPC contractors anymore. I'm going to insource that. I'm going to vertically integrate into that. So if you apply that mindset to any type of big hardware construction, and you stop outsourcing to companies that have their own ways, and now all of a sudden you're subject to their speed, then you can change things. It's a mentality that requires much more vertical integration. It's a mentality that requires very different talent selection, because experience is not as important as thinking from a first principles and trying to constantly improve things. And sometimes people with experience have that, but like sometimes they also just want to do the things they have always done in the way they did. So like you're changing the mix of the talent. So when you do all those things together, I think you can see what he's doing. Like we never thought that he could improve the batteries as fast as he did, or produce his cars as fast as he did, or the next wave will be robotics, these humanoids. Can this be done in 3 years instead of 10? Seems like we're getting there. And all those hardware, hard to do things, I think they're going to surprise us in a very positive way.
Elon is the king of hardware. I love it. I really like the idea and the thought around founder-led companies, even at that scale, even on the public markets. They do have an advantage in terms of transitioning into being more AI native companies. But Shopify and Cloudflare, they're like obvious examples. Elon is an obvious example to a certain extent. If you were to think about like examples that are way less obvious, but where you see the similar dynamic of successful transformation that will unlock a lot of value for those companies on private markets and public markets, what do you think those are?
So there's a lot of hope that you can bring these AI tools to old school accounting firms, for example. I think Thrive is doing a roll-up of those. We have one in Brazil called B-Hub that is buying the back office of the accounting firms, so that you don't have to buy the client relationships and pay a multiple for that. You're just automating the back office, let the accountant owner keep the relationships and have coffee with the clients, keep the clients happy, but you basically deal with all his people and that are now yours. There are different ways of going about this thing, but I think that's an obvious transformation potential. There is always the question of why don't you just build something from scratch using the tools and steal the clients away? Because stealing the clients is actually quite difficult. It's very costly. The unit economics don't make sense. There's so much status quo bias on that relationship, and they have all your prior data. They file all your prior taxes. What if you get audited, and who's going to have the data? Like, there's all these fears. Like, example, I have like 3-4 bank accounts in the US. I don't close the bank accounts. Why? Because now I have a preferred one before I had another one, but I don't want to lose access to my data if I ever need it. So I keep that thing open. Healthcare is another example. The way you deal between hospitals and insurance companies, between patients and insurance companies, between patients and hospitals, all those things can be massively automated using AI. Usually also, very expensive talent in healthcare. So for that reason alone, will be very interesting to see what's going to happen. Ultimately, you're asking yourself what uses a lot of people, what are things that don't require creativity, and that I can therefore automate. Because if you require creativity, then the automation is not going to do it, right? Like, all these creative tools still require the creative type, and very talented people are going to have a better way to monetize their creativity than in the past. Because in the past, maybe an intermediary would capture part of the rent, the economic rent.
Or even just shut you down.
Or shut you down.
Not just creativity, though. I think it applies across the board. I think you need to have a product, and this just solves your go-to-market.
Yes.
Right? So if you have a good product, whether it's like creative talent, whether it's a financial tool, or whether it's whatever it is, right? It just helps you go to market better. So I see it in my business. It's very helpful, right? Where like I don't need to go to pitch to investors or do like 1-hour meetings, right? It's like the market gives you feedback.
Okay.
Let me just say one thing for the context of the audience. Ivana has started her own actively managed ETF about 4 years ago, all by herself, 100% by herself. And she's got more than 100 million of assets under management now. She's doing really well. For those that don't know, actively managed ETFs is the most tax efficient product for any individual because the buys and sells within the ETF are not taxable. Only when you actually sell the ETF, you pay capital gain taxes. So it's the future. I think by the way, I'll tell you another example. I heard last week of several SpaceX employees or people who have Anthropic stock that are now in the process of creating their own actively managed ETF so that they can contribute those shares to this actively managed ETF. They can sell the risk, that there's super concentrated risk in a single company, buy the more broad basket, and delay capital gains taxes. So, so this whole actively managed ETF is going to be a booming industry. But in fact, if I were to start a company right now, I'll probably start a new tech stack for people to create their actively managed ETFs because it will be the best tax planning product you could ever have. And I'm not sure JP Morgan Private Wealth is providing that to people yet, right? But they should. But that's an opportunity for a business in itself.
You hijacked that part of fundraising and building, relationships with LP base one by one. So maybe talk a little bit about that strategy and how did you manage to cross that line?
Well, I think it's two things, right? First, you need to have the product. And I think what's been changing over the past several years, and even this is even ChatGPT, and I wouldn't say pre-AI because there was an AI before ChatGPT.
Machine learning.
Much more machine learning based, right? So there were tools, and that was just the beginning of it where you could use tools like AlphaSense was one where they would skim
They raised
transcripts.
just now, right? AlphaSense, they just raised, I think, no?
Yeah, I think so. I saw
380 million or something crazy.
And I think they're getting embedded in some of the platforms, the AI platforms.
Okay,
but basically that used to be you used to really need, if you want to run a portfolio, you'd need at least 1 to 2 analysts to be able to go through this transcripts and filings and put together models. So AI started emerging as a research assistant, and that really kind of changed the game for me, because what it helped me do is I can run the portfolio and streamline the research process, because it's really the research process that's key for driving the returns. So I think the cost of doing research declined, and therefore it enables people to be able to produce a good product or generate alpha without having a team of 20 people.
Where does the moat move? Like when cost of research is going down, technically everybody can start producing that, but you say that, it allows you to build a better product. So where's the better part coming from? Is it coming from the experience, the background, the human thing, or where
100% the human thing. So it's back to the creative, right? So you need the creative talent to make a movie. You need somebody that's experienced to be able to do
years
it.
in Citadel, Tigers, and so on and so forth.
Exactly. So the idea is that if you have a good product, you can amplify it. And that's really and as AI has been evolving, the ways, first the research part has improved, but what we're now focused on more is trying to leverage it more for marketing, right? For the go-to-market. The whole point of this is, how do you find the audience that is interested in it, right?
Community events. It's actually insane. I never imagined that community events and offline approach works for so many different industries. To me, my initial thought was it works for media, it works for consumer, but now I see what is done in businesses to build the communities and what could be done in businesses to build the communities. I think the opportunity is enormous.
I'll give you an example. There is a very unknown independent watchmaker that I love that I think is under the radar, that should be much more hyped than the hyped ones.
Do you want a name?
No, because the point is, I did something.
Is that the one that
no,
you
that it's another one. So I'll give an example. So I found collectors of this maker in the US. We started with 3 people. We're up to 32 collectors, some also outside the US. We created our Instagram feed on this, and now this is having many impacts, positive for the brand. First, whoever joins this collector group is less likely to then resell that piece, because now that piece becomes a membership to the club. Second, it's a communication channel between collectors who actually own these things and the maker. So if they want to hear some feedback, or if they want to propose new straps and match it, and what you can sell directly to the collectors. Third, prospective collectors are more likely to buy the piece because they see there's a community around that brand and they want to be a member of it. Because if you're buying something, you might not only something that is a physical object, you're buying community. Because there is a community, you're more likely to convert. In fact, I must say, in 1 month of this, probably converted 5 buyers. And these are not cheap things, okay? So it's an incredible situation. And then the last thing is, there's a lot of information that sometimes these brands don't fully disclose. In the case of timepieces, is like piece uniques, or did you know they're doing this next? Now everyone knows everything, right? Which is also a danger for the brands, because they can't screw up. They have to be transparent to build trust, because if they do something wrong, now 32 collectors know right away. So there is a lot of implications of community. I'm just taking this for one little segment of society. But the other beautiful thing about this is done by collectors, not by the brand. If the brand were to try to create a community, it would feel fake. The trust wouldn't be there. The authenticity perhaps wouldn't be there, because it's done by people out of their own free time and will.
Yeah.
It's genuine and has much more meaning for the brand and for people who observe the brand out in the wild.
Although this brand, have you looked at this company called Corgi?
No.
The InsurTech?
No.
Literally, the logo of theirs is this dog, the Corgi. And it's a company operating in the most boring industry. YC grad, obviously. But the way they built a brand, the way they built community, they opened a coffee shop or a restaurant called Corgi in Silicon Valley where they, invite all of those tech people to network and so on and so forth. It's actually a cool example of how a brand, especially coming from the industry where nothing cool and trendy and fun has been happening for a while, turn that around, put the logo of a really cute dog and build like a whole positive positioning around that. I actually think it's going to be a big thing right now, especially in the boring industries.
All of this, once again, it goes back to creativity. So there's certain ways of going to market and getting known, but then there's other ways where you're going to be a little more connecting the dots, a little thinking outside the box. And the whole marketing thing is changing towards this kind of thing. And not everyone can do it. I reflect a lot about this in our education system as well. I think our education system has been now tailored for measurement and tests because that's how we compare schools. That's how we compare people. The problem with that is if you train people just to take a test, they're not very creative.
They're going to score very well on GPA, but
they're not good in life, right? Like they're not resourceful. They're not good with people, like all these other skills that we want people to develop. I think marketing kind of went through the similar thing. We favor marketing that was quantitative, where the opportunity is to be opposite of quantitative. It should be human and then creative. And then you'll see that in the numbers, right? No doubt about it. But the way you think about it is not the same quantitative process that you thought about before.
And when you start thinking about, like, for example, investors in ETF, right, or watch collectors or HR professionals, these are all community, essentially, because those are people that are joined by the same interests. And I've seen this company in Brooklyn, they're doing barbecue for HRs.
Is that right?
Like, yeah. And they're literally like renting this, like a house, and they do like this massive barbecues for the specific community. And the thing is that conversion and NPS there is much higher because all of those segments are those that people never actually target.
I'll give another example since we're in this. There is a lawyer from Wilson Sonsini called Damien, I think. Correct me if I'm wrong, but he only works for founders. Lots of founders in LATAM use him. US founders use him. He refuses to work for funds. So he's basically counter-positioning, saying, I'm always going to be on your side. He has 3 houses in Montauk in the summer, 17 rooms, something like that. And any founder can come in and use the houses in the summer.
Smart.
So smart. And now he has a flywheel because the prior founders are, referring him to future founders. He makes probably more money with equity in the companies than legal services. I saw this in Brazil as well. The Pinheiro Neto lawyers who are experts in fintech, they're investors in lots of fintechs. They're making more money being investors in the fintech, in the startups, than providing their legal expertise. So they're actually bartering, like they're swapping their legal expertise for equity.
Yeah. The funniest thing is like everything that we're talking about right now, it's like anti-AI basically. Yeah. And nobody thinks about that, all of those massive communities, because they think that it's not the community of consumers, not like TikTok influencers. Yeah. But in fact, if you go with like strong strategy after people who were underserved, the loyalty that you can build, like among this unidentified watchmaker, right? Like it's very different perspective.
By the way, Olga, next episode I'll give you a gift, and I'll just say that. But let's switch back to the idea.
Wait,
No. Let's keep it a secret. Going back. One of the biggest things, Ivana, I want to hear your opinion about it. One of the biggest fears people have in this AI wave is a so-called air pocket of demand on AI that could be caused by, the Ubers of the world saying, hey, wait a second, you can't use the entire annual budget in a quarter. Or the ROI is not being the greatest. Or you use AI to rebuild all your systems from scratch, but now you're done. So you need less of it. I don't know. What can cause an air pocket of demand that can burst the entire positive flow that we have right now of the revenue ramp up of the labs being the fastest in the world ever? How do you think about that problem?
So I think it's a legit concern. And the reason why it's a concern is because right now, most of the AI usage is subsidized. And I don't know that people think about it that way. So when you're using ChatGPT, you're losing money for ChatGPT. Or when you're using Anthropic loses money on that use. And it's really all about how this company managed the transition. There's nothing wrong with that per se, right? That's how a lot of good technologies scale. You start using it until you build the ROI. And then at some point, the ROI is just there on its own and the monetization phase started. We're still not in that monetization phase. So I think it's really something to keep an eye on of how much it actually costs Anthropic to be able to
and the way we would
subsidize
see
this.
that is if they have to increase their token pricing.
Exactly. Yeah,
And what is the impact on demand?
exactly. So the key to watch is the token prices. Also, I think even from the hardware side, I think we should be starting to see like pretty significant decreases in token prices.
What you said in the beginning, that right now all of those companies maybe spend like 100 billion, right, on CapEx, and they need 3x of that. Do you think that is the reason why we suddenly see all of those companies going public, SpaceX and Anthropic, and there's a line of companies who would be going public? Is that one of the drivers, or what is the why now kind of answer to why now question?
100%. That's the why now, because
How many $80 billion rounds can you make?
Yeah, exactly.
Do on the
You're
pri- on
drawing
the
liquidity
private
from all
publics,
over the
yeah.
world. Yeah.
exactly, yeah. So, and we do need the compute. It's pretty obvious. Like if you want to build data centers in space or on Earth, you probably need a few $100 billion, right?
So when you've seen both of you, I'm pretty sure you definitely read that, but maybe
What?
you did too, the filings of SpaceX. What are the things that caught your attention in the documents? And what are the things that maybe even shifted how you think about what business SpaceX actually is and whether or not this current multiple of 60x is a fair one, undervalued, or overvalued, overpriced?
Sean McGuire from Sequoia actually framed SpaceX the best. SpaceX is about potential, and the potential comes from
Sounds great for public market.
no, but because most companies are about momentum,
Right.
and SpaceX is about potential, and where the potential comes from is a reduction of 99% of the cost per kilo of sending something to space. So he spent all this time reducing that. What you can do with that is now the business. The first business is the satellite business for data and Wi-Fi. That's obviously one that we have gone from 2 million subscribers to now 10, 11 million. The ARPU has gone from $50, $60 to something like $30. And we don't know where the ARPU is going to end, but that business exists. Okay. And we're going to have a Wi-Fi in planes. Finally, we're going to be able to work on a flight to LA or flight to Brazil. We are finally going to get there. There are many other implications. Perhaps you can have cell phones everywhere in the world without the cell phone towers, or complementing the cell phone tower coverage. Because when I do go home to Sag Harbor, there's lots of places that cannot talk on the phone. Like how come we're in the US and I can't have that access? But this is just the first business he built. Now, the next businesses are going to be more interesting. The most interesting of which will be data centers, because it's much easier to potentially cool the data centers. You can interlink all the data centers with lasers. Perhaps there is latency issues, but then for training models, kind of perfect. Like all these things, we don't know the answers yet. And that's what you have to pay for in the IPO. Why do I say that? Because the revenue for next year is only, 30 billion, give or take. This first quarter of this year, the company only grew 15%. And in the past few years was growing 30 to 60, kind of slow down the growth. And the growth in itself is, this could be the biggest short in the planet Earth, if that's what it is. But it comes with an option for, I would say, very clever option that they built with data centers for AI in space. And in fact, they entered that business by leasing the XAI data center to Anthropic for $1 billion per month. So they're starting that business, right? But on Earth. Now, the question is, can they do that in space? I would say, just looking at the metrics of SpaceX, it looks pretty darn expensive. 1.7 trillion is what, 60 times forward revenue for the growth that is not that great.
15%, right?
Yeah,
Right.
because look at Anthropic. Anthropic is a $1 trillion with 50 billion of revenue. But Anthropic is going to end the year with 100 billion of revenue. And perhaps we'll end 2027 with 200 billion of revenue. So it's actually a more exciting forward, more visible forward revenue growth. I feel actually a little better in terms of valuation of Anthropic than I feel
Which is also
SpaceX.
like about trillion, pretty much.
No, but it's much more reasonable. Whereas on the other hand, which company has more risk of disruption, Anthropic or SpaceX? Probably Anthropic, because what they're doing is special right now. They capture the trust of enterprise, but over time, enterprise are going to optimize for costs and they will switch to other providers. So, and then what's harder, to reduce the cost of a kilo in space by 99% or train another model with the trust of enterprises on Earth? I would say much harder to do what Elon did. So the moat that Elon built is actually perhaps a higher quality moat long term. But if it doesn't monetize effectively in the next 3 years with these data centers in space, then people are going to lose their patience and the stock's going to fall like a rocket. Right now, people are going to give the benefit of the doubt. I think one interesting thing, every single bank in the world was lined up for the IPO except for Jefferies. Every single investor in the world has exposure. So nobody will ever say anything negative right now. And they even convinced the index companies to change the index day one, both for Anthropic and SpaceX, where the IPO of SpaceX is what, $70 billion? The passive demand is about 20. So right away, the passive demand will buy 20 billion to sustain the post-IPO price. But my question is, what comes after? Because only 5% of the float was listed. All these people, all these employees, all these investors now have generational wealth tied to one single company. They need to diversify away. They need to sell. They will sell. And when that wall of shares comes to market, in the hundreds of billions of dollars, who's going to buy that at the current price? So odds are that if you are a believer in SpaceX for 2040, perhaps you will have a better entry point. That's all I'm saying. I think the probability you're going to have a better entry point, 75%. My guess, okay? I don't know. I think this index, adding these companies to the index day one, against their own historical rules, it's an interesting thing. It might backfire because it might create so much weight in these companies and they might underperform because of the lockup expirations, which might drag the entire market down. So I think in hindsight, they may look back at this and like, oh shit, we made a mistake, right? We should have waited 6 months, just like we wait usually. But whatever, they did it. It's done. It's going to happen. My hope is that for this thing to go well, I am a little skeptical just because everyone is biased. Nobody's going to ever say the truth. I have a feeling that lots of hedge funds will wait the index buy and then they're going to short this thing like there is no tomorrow because they will see the flow coming. And what will be the flow of positive news coming from SpaceX? Ultimately, you need positive news on the data centers in space, which ultimately needs to have a piece of hardware in space working and cooling itself down and being cheaper than on Earth. How long is it going to take us to get there? I think if you have something operating in space, then I think people start buying the option. Until that happens, people are just like, oh, I hear you. You're amazing. You're the best on Earth to ever do anything. But, until you do it, I'm not going to pay up for it.
Ivana, 1.77 trillion valuation, 60x forward revenue, 15% growth in Q1. How do you feel about that from the public markets perspective?
Well, I think Paulo is spot on. It's really all about the potential. And I think people...
But how often do
not...
public market investors actually buy potential?
Often.
They do
in good
often.
Times. In good times.
In good times, exactly. So that's key, right? That this is a pretty risky investment. I think it will end up working out because what SpaceX has, nobody does. to your point about the moat, I don't know if people quite appreciate the fact that they're the only ones that can bring this cost reduction from and it's massive, from $3,000 per kilo to 300. The next competitor is going to try to do it in 2 years, right? So it's years ahead of time. So
and
I
with
think
speed
this
of
is a really...
execution, that's compounds even into much higher.
Exactly. So I can easily see a multi-trillion-dollar valuation, not day one, right? And I think all the points you brought up about the flows are valid. Not day one, but I think over time, if SpaceX ends up developing hardware in space as well as on Earth, I can easily see that valuation being justified. Doesn't screen, if you compare it to everything else that's trading on the public markets, I mean, Micron is $1 trillion company, right? So it doesn't seem surprising to me.
I loved your point on Anthropic, which you said is that disruption risk and potential in terms of SpaceX. But if you were guys buying now,
I'll
the
buy
moment
Anthropic now.
you'll buy Anthropic,
Yeah.
what would you buy?
I'd probably buy both, but I would prefer SpaceX
No, you have to
for a long term.
Oh, so you're gonna buy SpaceX?
On a
You're
5
gonna
year,
buy.
so on a 2-year basis, Anthropic.
Let's
On a
say for the
5-year
next
basis,
year,
exactly.
For the next 12 months, I prefer to hold Anthropic. For the next 10 years, I prefer to hold SpaceX. But also there's an opportunity cost of capital. I think I might have a better chance. And in fact, both maybe, but mostly SpaceX. Now, this whole thing leads me to a thought. So wealth creation for employees and the lockup of that wealth creation. The best system I've ever seen is from BTG Pactual in Brazil, where the partners of BTG can come in and out at book value, but not at market value. So if you want to move out of BTG, no problem. You can sell your shares back to the partnership at book. And the partnership is happy to provide you liquidity at book, and then you can do something else, and you lose access to the 26% ROE that they have in this compounding over time. Just so that you guys put some reference, the book value of BTG is about $12 billion. So it's compounding at 26% a year. Put it 26% a year, this thing is gonna be 50 billion soon.
Yeah.
One of the reasons why you don't want to leave as a partner is you don't want to leave something that is compounded at 26%. Now, what's the problem of allowing people to sell their shares in public markets? Is because instead of exiting a book and losing the compounding, now you can exit of something that you perceive to be overvalued. And in fact, it accelerates your exit of the company. Because if you think the stock is overvalued, you want to get the heck out of it, dump the shares, and do something else with your life, because you think that your $100 million worth of SpaceX stock is going to become 20 and you don't want to lose 80. You're thinking about losing, you're not thinking about compounding. So I think the tech ecosystem, I'm a big fan of super voting stocks, giving Elon control or entrepreneurs control, because they need it for these long-term builds. What I don't understand is why Elon and Mario and all these other amazing new, once-in-a-lifetime entrepreneurs, why they don't create a system of allowing the employees to either only sell 10% of their holdings per year, and if they want to exit, they have to sell at a massive discount to stop the talent exodus that we see in startups. I think it's about time that the tech Silicon Valley ecosystem creates some kind of lockup of employee stock that penalizes people who are leaving. And the sad thing is a lot of people that are leaving with 100 million, what do they think about? Oh, I can be an entrepreneur now. I can create hundreds of billions of value. The truth is that very few of them will succeed. And in fact, they will be probably more unhappy after 10 years than had they stayed at SpaceX changing the world. It's almost like the system can also become an incentive to protect people from their own stupidity in a way. I'm mentioning this because the thing that worries me about the stock price now for SpaceX is not the investors who are in it, it's the employees who are now thinking about that too much because they have so much wealth tied to it. They never thought they would have so much wealth tied to this thing.
Will they run as
Can they do their job without looking at the screens every day, without freaking out every day? You know what I mean? It's a big deal. Like if you're running SpaceX now, you got to worry about this stupid stock price.
It's a psychological thing, right? Like how
Massively
do you...
psychological.
It's a massively psychological thing. That's actually the reason why you don't want, like when you buy out founders or early, you don't want them to sell off too much, right? You want
Correct.
them to generate just enough wealth to
Feel
to
good
be
and
okay,
take
to
risks.
put children to great school, to own a house, but then be laser focused on delivering. Especially, I love what you're saying in the case of SpaceX, right? Like risk is so high because all of the things that they're building out is so not validated just yet.
Can you imagine how many calls anyone who works at SpaceX gets every day for a job offer? Can you imagine their LinkedIn profiles and the messages in the LinkedIn? Like, it's ridiculous, right? Like you almost need a talent agent to manage their careers because there must be so many people who want to access that talent.
All right, we have to wrap up this conversation. And I have a closing question for you. Like, if you look at this state of the public markets today with this mega $1 trillion IPOs, and you would be giving an advice to people who are now getting into this gold rush and aspire to buy stock, what are the important things to consider for those who are not that experienced?
So I think the key to keep in mind is the risk reward for each position you're taking. So as we spoke about with Paulo, if you want to invest in SpaceX, you have to know that it comes with significant risk. So,
and it's like for 10 years minimum.
For 10 years, exactly. So it's very important to understand your investment horizon and to balance the positions you're holding so that you have some that are 10 years out. You have some that are immediate and have significant cash flow support. Like NVIDIA is a good example. Like from here, it's not going to be doubling every year, right? But it does have a lot of cash flow. So in a down tape, maybe it's down 10, 20%, but it's not going to be down 90, right? Some of these other companies that have run up a lot, they don't have that cash flow support. So I think the key investing here in AI is to understand the dynamics for each investment and how much risk you're taking and how much you're willing to take.
Do you have anything to add to it?
So there are two risks. Most people have zero exposure to AI and the future. And those people are running a massive risk of being left behind in terms of their wealth. And then some people have a lot of exposure, then they need to be careful. But given that the vast majority of the people on Earth have almost no exposure, my biggest thought is how do we make people have exposure? So that whole initiative by the Altimeter guy and others who create $1,000 account for every newborn in the US, forcing people to own the future, or any other similar risk sharing or wealth transfer, intelligent wealth transfer mechanisms on Earth are going to be critical. Because the thing that worries me the most is the wealth concentration as a result of this boom.
Yeah.
Because at some point, the peasants are going to revolt and cut the head of Marie Antoinette. That's really what we're talking about here. Because if only like 0.01% of the people on Earth have a super yacht and can have meals that are $10,000 and expensive timepieces and all this stuff, right? Like at some point, the people who are suffering are going to say, enough of this shit. That's the biggest risk.
All right, guys. Thank you so much, Ivana. Thank you so much for joining us. I think we have enough for round two.
Yeah, thank you.